Okay, hello folks. Welcome to State of the Market. I am David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Today is Monday, August 5th, and wanted to just very quickly just go through some quick disclosures before we look at our charts. Now, remember, this is a webinar that we do um, on Mondays to look at the major sector funds and the major indexes. We look at them mostly with weekly charts, and we're looking at trying to kind of understand really the state of different sectors and different trends and different indexes in the market. So those are the disclosures. I'm also going to show you right now some standardized returns. These are the standardized returns of certain key ETFs that we're going to be talking about. And looks like everything is going now. I'll just show you these. All right. Now, as we speak, I want to tell you also that if you go to tradestation.com and you go to Insights, we have a couple of blog articles that I want to just very quickly mention. First, you might want to take a look at this blog post. We did it last week to show the dramatic reversal day that we had on Thursday. It was a pretty interesting one. We talk here about special kind of indicator. We're going to be talking about that more soon. But it's just an interesting little example of ways you can use TradeStation's kind of a platform to do certain kinds of analysis, and you can customize indicators. And then also this one with the bear. The main thing I wanted to point out on this is in this article we identified and it mentioned a level, which was basically on the S&P 500, this level right here. What was really noteworthy is the fact that the 10-year Treasury actually last week had its biggest decline in basis points since March of 2020. So this indicator we're going to be sharing with you guys on Thursday in our market trends webinar. All right, so it's amazing I wanted to mention. Now, right now, we identified a level in the S&P 500, which was 5192, which is an area that we're pretty close to right now. And when you consider the volatility, we're at 15 points below it. But I think it's an important level here. So I'm going to start off very quickly looking at the S&P on the weekly chart. And so we're using TradingView for this just because I saved some levels and things, and I keep it in one chart, and that way all my levels are kind of easy to access. But what's interesting here is when you look at, we're going to be looking through these ETFs here. So if we look at this, I think, the level that I cited in the article was this low it was really like kind of late May, early June, weekly low around 51.92 that we're trying to hold. It also represents roughly a 50% retracement here of the rally that we had really since the beginning of this calendar year. So these are some interesting sort of levels now. And I wanted to just mention that when you look at it, I'm going to actually just quickly jump back over to TradeStation because we actually have right now the market the most oversold it's been by various measures in a long time. I have some kind of just special charts I want to very quickly share. This is the S&P 500 with hourly candles with the Wilder's Relative Strength RSI index. I have noticed that on the cash index, the RSI on the hourly chart can be a pretty useful indicator, both for overbought and oversold in terms of looking for potential entries. You can see even in sort of like bearish markets. I mean, even from a short-term perspective here, back here, even this is over a year ago. You can see even at that point it was oversold. It did rebound before it continued lower. But the thing is, we've now hit some oversold levels here. Also here you can see it was oversold at this point on July 25th. It did rebound before it continued lower. So I think the key point is it usually when things hit this oversold level, the pattern over the last year or so has been that the kind of shorter term move has been higher. Also, I want to point out that if you look at the Nasdaq, the Qs I'm looking at on another screen on another computer, we are trying to hold a 50% retracement of our from the low from the beginning of the day to our high of the day. Right around, we're right now trying to hold that. So I think it's kind of important. We don't get into intraday stuff very much on this webinar. I wanted to mention that this is a high volatile sort of day, and things like intraday levels do matter. But if you were to look on an intraday, like a 5-minute chart or something of the Qs, and you draw a 50% retracement from the low of the day to the high of the day, you'll see that the level that we've been holding in the last 5 to 20 minutes is a 50% retracement of that range. But also that was the RSI on the hourly chart. Now here's a custom indicator we have. It's basically, these are 4-hour bars, which is another way to kind of look at things. This basically shows the distance. So with 4-hour bars, we took a 50 period moving average, And this shows the distance from the 50-period moving average. So you can see they were pretty far down. I mean, it has gotten worse at different times. It's gotten more bearish, but it is also, the lowest right now since October of 2022. Now, this right here was the bearish outside day in October of 2022 on the CPI report when the market bottomed, the bullish outside day, I'm sorry, when the market bottomed and has continued higher since. So at this point, this was that oversold level. Now, what's interesting is the market was trending down at this point and it got very oversold, but it's been trending up now. And so what's interesting is, you know, the market can get more extended when it's trending in a certain direction. So the thing is now, this is the most oversold that we have been since the market started trending higher. And I think it's important to realize we are more oversold now than we were back in October of last year of 2023, which was already, we already rallied off, the lows of 22. So we're at a point here where within the context of an uptrend, having made a new all-time high less than a month ago, we are now the most oversold that we have been. So I think that's an important thing to realize. And something that might be kind of a sign more of a potentially sort of maybe bullish thing, just to think about, or at least a sign that the direction has been to the upside, and at this point, the current state, the current condition of oversoldness is pretty extreme or high relative to what we've seen for over a year within the context of an uptrend. So I think that's important. These are the moments that we saw further back where we're in the context of a downtrend. Back here, this was in the context of a downtrend. So now the same thing with the daily chart. This is something else. I have a personal kind of interest in the 10-day simple moving average, which I have here. I don't have it on the higher chart, but this is now a daily. And this shows the distance from the 10-day simple moving average. And you can also see that, this was COVID. So we're looking back a long way here. If you look overall in the same period as well, that we're well below the 10-day moving average, 4.5% below the 10-day moving average. That is also the most oversold since September of 2022. So again, we're at a point here where you can say that the nature of this pullback on the short-term indicators is pretty far outside of the kind of norms that we've seen recently. So I think we have a situation here where people could argue that we have a short-term oversold condition that's pretty evident. And it seems to be kind of, something that one could make a reasonable observation to think that this is an oversold condition. So I think that's important to realize. And the fact it's happening within the context of an uptrend, within the context of a consensus the Fed's going to be cutting rates, and within the context of basically new highs and things like that happened less than a month ago. You put all those things together, and this might be something where people actually think that this could be a potential for a bounce. Someone just kind of think about it that way. So that's the first thing here I want to kind of start with. Don't forget, we will be on market trends on Thursday afternoon at 2 p.m. when we're talking about more. Before we even go on more, I have to show you HGX. I know it's kind of not something everyone talks about, but the housing ETF, the housing, what is this? Not. There was a retracement here that didn't save. Anyway, all right, so this is not the ETF. This is the housing, the home builder index, but this thing had a really violent rally in July. We're holding half of it. We're also back near this high here. So I wanted to just mention this one because there's various levels here. People might look for support in the home builders, but I think right now it's very interesting to kind of see the home builders here with the idea of interest rates moving lower and things like that. We don't normally look at that. It's not an index I'm going to look at all the time, but I did want to mention here that the home builders are an area that if we're seeing rates move lower and things like that, they had a strong rally last month. They're holding half of it, and at the same time, they made an all-time high last week. Not a lot of other indexes did. And then also here, you could see here in terms of weekly closes, there's a level here kind of going back to mid-May that then was essentially that high in early July, and then it was that that kind of level that was broke out through it and now held it. So there are some areas here where people might start to think that the home builders, in the context of expected rate hikes or rate cuts, are something that people might be looking toward. Now, another thing, we had talked about the banks, and I'm just watching right now, and I'm not saying this is necessarily something, I'm not really sure what to make of this, but I'm now just there's two other thoughts I have. First of all, I'm watching the ratio of things like the banks against the chips. There was evidence of a rotation towards the banks recently and away from chips and all of that. But we have to be careful. I mean, this is something that was now a really like, hyped up sort of idea. And so you have to wonder, will the longer term momentum come back to the chips? So I'm just kind of watching one against the other. And I think that's just kind of something we have to do right now is be kind of thinking it's possible we're going to see this continuation of money going into banks, but it's also possible people are going to say, wow, the semiconductors have had a massive pullback and this might be an opportunity. I also think it's important to realize here is that we've had a lot of bad news in terms of risk with China, of trade restrictions on chips. Some reports today that Nvidia is going to delay its Blackwell chip and things like that. But I think we have to take a step back and just do something very quickly. I just got to show the Nasdaq. I'm going to just show the the NDX really quickly. This is it. I'm sorry, NDX. The daily chart here. This is the first pullback to the 200-day moving average since the AI rally started in March of 2023. What do you have coming up in the next 5 to 8 weeks? You have Nvidia earnings later this month. And then on top of that, you have an expected iPhone release. In the first half of September, people are saying, if you look at different websites that follow, Apple closely, there's different people throwing around dates in the first half of September for a potential iPhone event. I don't believe it's been announced yet, but those things are out there. So I'm gonna just mention that out. This right here is the Nasdaq, and then also the semiconductor index. I think is also back at that 200-day moving average for the first time, in a long time. This one was a little bit back in October, but I think we need to just realize that these are sort of spots where people, I think, can take a step and start to think about maybe, things being at a spot where they might want to be a little bit more willing to be adding over long-term sort of ideas. So let me just proceed now with my weekly charts. I wanted to mention that because in particular, I found it very interesting to look at the fact NASDAQ hitting that 200-day moving average, but also on the daily chart of the S&P, like I said, this level from it was the end of May, beginning of June. It's a 50% retracement of the year's level. Very volatile market we have right now. It's August. The market's been negative for the last 4 Augusts, and I think that's I'm sorry, the last 2 August and the last 4 Septembers. If you actually look, we talk about it in this article here. We just kind of looked about how that seasonality. We basically said here that the market. I mentioned it here somewhere. If you want to take a look at the all right, yeah, the last 2 August and the last 4 Septembers. So that was when we had mentioned here. So this level from the end of May is, I think, one now that is, kind of interesting that people might be watching. All right, now look at the weekly chart of the Qs, and we basically have a level here that goes back to the very beginning, mid-January. This level. Now I'm looking at the Qs, not the NDX. It's kind of 421 level. You can see that it was a high, and then various times we bounced at it. Again, we're relatively close to it, so this might be a level that's on some people's radar at this moment. Then to the upside, this level around 448 is something that people might be kind of watching as well. It was kind of the close last week, but you can see it had relevance going all the way back here to mid-March, and it was, an area that we held in early June before we continued higher. So that level to the upside around 44, kind of 448 and a half ish might be that sort of area where if people look for a bounce, that might be the kind of spot that they are kind of looking to. Now I'm looking at the Dow, and the Dow, started having trying to break out recently. Here's some levels. It's trying to hold this level from essentially mid-June. I'm just kind of watching, and I think the problem with the Dow, the Dow to me is becoming less and less relevant of an index. But I think that the concern with it is it has these sort of spaces down here to the downside. And the other problem with the Dow is, you got Intel and Boeing in there, and those are just companies that seem to have these strange sort of risks that come out of left field. So I wanted to just kind of mention that. But this to me, I'm watching. People might be trying to look for some support here, but the fact is that all of these areas down, through here. One of the things I've often noticed is that when volatility, is underway, things widen out, and we'll try to probe the wideness of their ranges, and being too tight on the ranges in terms of entries can just result in things whipping out to the outer parts of their ranges. Also, if you look here, kind of going back to late December, you can also see that this level has, this level around 3770, 700. That was the low in mid-April, but then it was also that high at the end of last year. So, this people might look for this weakness to extend lower in the Dow. Now the Russell, what's interesting about the Russell is this one has, kind of held this low from just here in mid-June. And I think that's very interesting. There's another one of these things I'm kind of wondering about is, are we going to see this relative strength in the Russell continue? But the other risk is, will it also extend to that low right there? Again, like I said, when periods of volatility, you have to recognize that things can widen out instead of being tight. Now, XLB, well, actually, we got to look at TNX first. Excuse me. you know, we're going to take these lines off. Last week, we were talking about the steepening downtrend in the 10-year Treasury yield, and that's exactly what happened. We saw last week, like I said, the 10-year Treasury yield had its, I think, 41 basis points down, the biggest one-week drop since back here in COVID. So, this is something that I think we also have to realize. This is, something of an overall, positive for risk appetite and for people's outlook of stocks and things like that. Now, it's also interesting here to look at back to April here, um, beginning of April. I mean, that's still, people might be thinking of, I'm sorry, the April of 2023. I'm not this year. Trying to right now hold the low from December, but this low from April of 2023. At this point, when you look at this, people might see space down toward that. So I think it's important to realize here is that the kind of this sense now of lower yields is pretty well established. And we've talked about this chart in different ways, and the way that it's been making these, the steepening downtrend, the fact that it failed at this old level, the lower highs, all these different things on this chart. I think it's interesting when you look at this right now, and people might be thinking here that if the long-term high in yields is in, we could see a kind of continued downward draw. It's also interesting. I know that people don't pay much attention to it, but the government's fiscal situation is actually doing pretty well, surprisingly. And some of the data they put out have said that they're not going to sell as much debt as people had feared. So there are some situations here, I think, when you look at, the weakness out of China and other things like that, the idea of the Fed cutting rates and all those things here, we might be in a spot where the yields have that downward squeeze. And at the same time, the question is, if we don't come through with real, like, seriously recessionary data, at a certain point in time, people are going to say, you know what, yields are coming down. The economy is not really in recession; it's weakened, but still has positive jobs, and things like that. People could kind of quickly come around and say this environment is not as recessionary as we feared. So I think it's important just to realize that this situation in the 10-year is not overall a negative on equities. Now, the materials index, I mean, we've been kind of watching the XLB. I'm going to kind of just take this off because I don't even care about this line now. But what's interesting is that we have this range on here, but we have a lower high as well. So I'm watching materials here, and I'm wondering if we get more of a kind of beat down toward these highs from December. To me, this is something where when you look at the situation in China and you look at this overall sense that we're in more of a deflationary potentially environment now, people will not want to be necessarily as bullish on things like XLB. This might be something that sits. But then remember, when we get toward September 18th, that's when the Fed comes into play. That's when people can start to say, wow, the Fed's cutting, the Fed's cutting. So something like this might basically be on a hibernation period until we get close to the Fed. And then people start thinking, when the Fed cuts, it's going to be good for materials, things like that. Now, the communications, what's interesting here is this level here that we're at kind of has a lot of support potentially. I'm going to just adjust this really quickly, but show that the level we're trying to hold around just under 82, it actually goes back toward this time. I'm not going to adjust here, but this high in mid-March. So I think right here, the communications sector, which is Meta and Amazon, I'm sorry, Meta and Google and also Netflix. These are holding some levels here that I think is something which really stands out in comparison to XLK, and XLY, the other big growth. You have basically the mega caps are in three sectors. They're in the XLK, which is technology. They're in the XLC, which is communications, and they're in the XLY, which is consumer discretionary, which has Amazon and Tesla. If you look here at XLC, which is the communications. Of the three, this one is holding the more recent high. So I think this is kind of interesting. I think it's important to see if this kind of continues to hold. I think we do need to also realize, I mean, there are some levels out here people might sort of watch, but again, this is Monday, and again, is this an area that people start to look for things to hold? Now, energy was an area that we have, mentioned a lot of kind of risk in. We had mentioned this bear flag breakout, and we did get the downside continuation. And then when you look here at the XLE, we have geopolitical risk in the Middle East. I think it's important to remember that. We have to kind of remember that, there are, such things happening there. What I'm doing is I have basically a price alert on oil. If oil starts to spike, then I'm going to start to pay attention. But otherwise, it's one of these things where you just don't know what form it's going to take. And I think we just have to kind of remember that right now is that the real indicator will be oil, and that will, if things start to happen in the Straits of Hormuz with Iran and things like that, the oil market will be probably one of the first things to kind of confirm it's not just some random rumor. I saw some random rumors on Twitter last night, completely fake news from what I could tell, and I'm seeing a lot of kind of random noise out there. Who knows what's going on? But the guys in the oil market know. So watching the price action of crude or something like that is, I think, a way to kind of know where things are going in terms of geopolitical risk. I mentioned that because in my view now we're at a spot where the recessionary slowdown risk has now been priced in. And the other risk that is potentially out there that could come and bite us is geopolitical. But the thing is that usually if you worry about geopolitical risk, usually when it seems the worst is the time when the market bottoms. So the thing is to really worry about it is something that doesn't really necessarily lead in any direction. So I wanted to, just mention that. Actually, wait, one other thing I want to very quickly share. I forgot to add these. I'm going to add these now. I have some disclosures I'm going to add in the chat. Sorry about that. If you want to see a link to the various disclosure pages we have, I'm going to add them into our chat. Okay. Now, so anyway, XLE here. I think when we look at XLE, we have to just kind of realize that, 80 this low from early in the year, I mean, people might think it's in play. And I think we just have to remember that, global production is increasing, and OPEC plus and whatever, I mean, these guys are not united. They came together in a major way during COVID, and they've been slowly crumbling ever since. And at the same time, American production continues near highs. Everything like that. You have Trump saying he wants to drill a ton of oil. Even Kamala Harris is now backing away from strong anti-oil, sort of rhetoric. So I think if you think about it, whoever wins the election, the likelihood of continued American production, is in the cards regardless of who wins. So basically, we're at a spot here where you look out into the future, China's weak, oil production is increasing, OPEC is at each other's throats or at least not united, and they all want to increase production after all taking a hit during COVID. All those things together to me here, I think, remain something that are, something we have to think about as being a potential drag on energy. All right, now the XLF financials here, this to me has some sort of, there we go. My lines are not, I saved some lines before, now they're coming in. This is trying to kind of hold, some levels across here. My perspective is that, there is a level, I'd drawn it and it didn't save, but there's this level from this week right here, the June kind of the last week of June, last full week of June. And, we're trying to kind of hold it around 40.71. There's also that level down to the lows of June. I think I want to just kind of watch this here. This is something where I think that, the fundamentals for financials, it's interesting. There was an article on S&P Global Intelligence that actually said that banks have lower loan losses than expected. And I think that we have to just remember now is that the situation for banks is, with rates coming down, this is another thing that to me, people might say, what, long term, if I'm rotating out of AI or I'm taking profits in NVIDIA, where do I go? Things like financials in a rate cutting environment might be a kind of place where people look. So I think right now we have to realize here is that financials are in a spot, and what we might see in a bullish market, if they are, kind of bullish, it was an all-time high not that long ago, they might hold and sit and then for a week or two, and then when things calm, we might see that kind of continuation. So wanted to just kind of mention that this is, to me, very interesting to see this making these incrementally higher lows. And really, the S&P right now is back to levels, like I said, from what from if you really look at it, our lows today, we're back all the way back to late April, early May. Our financials, we're back to levels basically from late June. And that tells you something. The more recent lows that you hold at kind of gives you more of a sense that it's more of a relative strength at work. So to me, financials here continue to look an area that people are going to be focusing on, looking if we can hold around that $40 level on XLF. XLI, now this is a clear range is emerging here, and I think we have to just realize here there's kind of 120 to 126. Again, everyone's worried about recession, but the thing is if we start to say, all right, it's not as bad as people fear, this thing is, again, holding some higher levels here. This is maybe something I think that people could be, kind of interested in. So I want to just mention that is that basically this 120 level on the XLI has been very meaningful, and it's holding that level at a time when there's all this fear about recession. So the real recession fear is hitting the technology stock. So what I really think we could have here is we just could have people unwinding an over concentrated trade in big tech, and basically then people go on TV and they have to talk about something. So they say recession. At the same time, we have this freak event happening with the yen that, happens it used to happen a lot, and who knows if it'll keep happening, but you can read about the yen carry trade. It's one of these things that used to be an issue like 12 years ago or something, but maybe it will become a problem again, or maybe it's just some flash in the pan. I think we should have to realize there were a bunch of freakish things in the market in the last 3 sessions. And anyway, but it's pretty interesting to see that the industrials are trying to hold this level, this kind of range, and at a time when people are talking about recession, because if that recessionary talk fades and people actually start saying, it's not as bad as we think, and the Fed's going to be cutting soon, something like industrials here holding these higher lows above the old levels, this might also be something that is at a spot where the risk reward holding the support might be, something people look at. XLK, again, now this is back to these levels from late April, and I think right now this is also something where it held that level very, very smartly. It came off the lows really aggressively. By the way, the Qs now I'm looking, and we are continuing to hold that intraday level at the 50% retracement of the intraday move. So I am watching that on my other chart on my other screen. So anyway, here I want to just point out here on the XLK that we're basically now, we have this low from last week that was our immediate resistance that we hit, but we also have some other levels up here on 205 going back to late May. That was a low that was the high of last week that also could potentially sort of be in play. If the market does have a quick rebound to the upside, it can be useful to have these levels in, kind of in mind, to be thinking about, maybe that's something where people are going to be looking at, kind of top. Also, this is a weekly gap here. So I think it's important to realize that we do have something of a weekly gap here between kind of 210 down to like 206, roughly, on the XLK technology ETF. All right, so XLP is, we had kind of, this is just interesting. I mean, it's just kind of sneaking the highs. I don't know much about this to really think about it. It's interesting to see people hitting it today. But I mean, I don't have much to say about consumer staples. Pretty boring area. The one that's more interesting potentially are the real estate investment trusts. This is one that had been kind of, last week we had, we kind of mentioned the momentum in it, and with the idea of there being rate cuts, this is also something that people might kind of look to. So I think it's interesting here to kind of see, hitting this highest level here in over a year, since the beginning of 2023. Not a fast moving sector, but again, this is something now that is in a pretty tight range. It's digesting after several moves up. People might just be kind of watching in here around 41. Nothing to rush maybe, but people be watching to see if it kind of holds. That's the XLRE, and the same thing with utilities. Here we are kind of digesting after a pretty strong move. There's a 50% retracement, kind of around 72 here. So I think we have some highs from May. We have the retracement that could potentially be in place. So I think this is another area where the idea of rate cuts and things like that this is something where some people might be kind of looking at some of these levels that I'm mentioning here. I'm looking at interesting also mentioning healthcare, which I think the XLV here, it had this kind of breakout through this line, but now it's trying to kind of hold these highs from kind of mid to late June. I'm just kind of watching this to see, in some ways, if we see utilities do badly and healthcare do badly and consumer staples do badly, that could actually be a sign that the risk appetite is coming back. These guys are often contrary indicators. So I want to just kind of point that out as well. I'm just looking here at XLV and, kind of looking at these old highs, but also this thing might be a giant nothing burger in terms of people's interest. They have, this trend line could even come into play. So wanted to mention that, but as I even look at these, I think that the bigger picture might be just a broader sentiment. Last thing, the XLY, which is Amazon and Tesla big time, is trying to hold these lows from here. And from my perspective here, as long as these kind of hold from here, people might actually be, even thinking of some sort of recovery toward this sort of level here. So I want to just kind of point these sort of these things out. Like I said, we're in a spot here where um, we've priced in a lot of bad news, and there are a lot of signs of being oversold. And when you have the context of an uptrend, things might actually be at a spot where people think that this is actually more of a kind of counter trend move, which may potentially give an opportunity. In terms of the daily charts, I'm just looking here to see. I have some other things I want to. There's nothing really on the daily charts that are that important. I only cover daily charts when they're more important. So remember, we will be doing our if you go here to well, if you also look on Market Insights, but on on Thursday afternoon at 2 p.m. we will be doing um, um, our next market trends. If you want to check that out, and when that time we provide some workspaces and some other things to help you guys. We will be sharing the indicator that we used to actually come up with this really cool analysis of the 10-year making its biggest decline since the pandemic. The indicator that I use in this chart right here, I'm going to be sharing that on Thursday. So go ahead, go to tradestation.com, go to the learn section, and then you can go to events and you can sign up for market trends. Hope to see you guys then. I'll see you soon and have a good one. Thank you much.